The banking sector is bracing for the Fed's interest rate decision later today as regulators are walking a tightrope between trying to cool inflation by continuing to raise rates without further destabilizing the banking system. So recent rate hikes lowered the value of investments, contributing to the collapse of SVB and the rescue of First Republic. Well, of course, because of their bad management decisions. The Dow is down slightly after rallying Tuesday when Treasury Secretary Janet Yellen tried to calm fears about instability and contagion.
Let me be clear. The government's recent actions have demonstrated our resolute commitment to take the necessary steps to ensure that depositors' savings and the banking system remain safe.
And bank stocks did rally afterwards. Joining me now is Harvard economic policy professor Jason Furman. Jason's also chaired the White House Council of Economic Advisors in the Obama-Biden administration. So good to see you. So, well, I don't know if you have a bet. We'll know in a couple of hours the speculation on whether the Fed is going to raise rates by 25 basis points or stand pat, maybe with some kind of a tough statement signaling that they are still committed to fighting inflation. What do you think that the Fed should do?
Yeah, I think what the Fed should do, and I think what the market thinks they will do, is raise rates by 25 basis points. That's lower than they probably would have done absent the collapse of Silicon Valley Bank. It looked like they were on pace in light of the increased inflation rates we've seen lately, in light of the very hot economy we've seen lately, to step that up to 50 basis points. They're definitely not going to do that. The big thing, though, as you said, is how do they communicate that? What do they talk about what they do in the future? I have much more suspense on that question.
And how do you think they should be balancing the fight against inflation? Should they take their foot off the brake for a while, given the instability in the markets and the possibility that what's happening with the banks is going to have an effect on slowing down loans, making it harder for people to invest, and will slow the economy?
I think they need to take into account the events that have happened, in part because they're going to do part of the Fed's job for it. Demand is still too high, inflation is too high, but a lot of banks are in the process of cutting back their lending right now. And so that means the Fed may not need to raise rates as much as it had expected because banks are going to do a lot of the job on their own. That being said, I do think the Fed needs to make it clear that their job is not to rescue the financial system by cutting interest rates. Their job is to set interest rates in order to control inflation, and then they have other tools like lending facilities if the financial system needs liquidity assistance.
Jamie Dimon, of course, of J.P. Morgan Chase, has been leading talks, after talks, obviously, with Janet Yellen and the Fed, about getting those other 11 banks to join in supporting First Republic Bank, which was in trouble. And now they apparently need to get more people to kick in some money. Is this raising fears about other mid-sized banks?
Absolutely. There is fears about other mid-sized banks. Part of it is similar business models and similar challenges. As you said at the beginning, when interest rates go up, asset values go down. And so some of the assets of these banks went down. Some of it is a form of psychological contagion that the Treasury and the Fed have done a pretty good job of containing. Deposits are returning to some of these banks as there are more, implicit guarantees extended to them. But ultimately, the best solutions here will happen within the private sector. There's a lot of healthy banks. They can hopefully do what they can to take care of the unhealthy ones.
Jason Furman, as always, it's great to have your expertise. We'll see in a couple of hours what Jay Powell does announce.